Well, we got that big rip up to the upside in the S&P 500, and it continues to just plow through big green candles to the upside. Dow Jones Industrial Average reached up to all-time high territory. Nasdaq 100 petered out ever so slightly today, but has also been on a monster tear. While small caps, the Russell 2000 ETF here, the IWM, has been really just in a period of consolidation. The question on everyone's mind is, hey, are we going to see this market roll over after this big rip, or should I just force into this and chase it to the upside? Well, it's anyone's guess, and we're going to talk about the bullish cases and bearish cases today. But I will say this is looking very similar from September, October, November of last year as of right here. You're watching the Stock Market Brief show. My name is Michael Silva. If you're new here, welcome to the channel. I use technical analysis and intramarket analysis to get a good idea as to where the market might be headed next. Let's get into today's show. All right, everybody, welcome back to the computer. We are looking at the SPX on the weekly time frame, and I have a little screenshot here that I pulled last Friday during the close. And what this is from Thinkorswim platform. It lets us know what the options market is pricing in for the S&P 500 going into the following week. And what we're seeing here is around a $61 move. And guess what? Since the start of the week, the S&P 500 in a few short days reached 64.82 as of right now, is up 1.45% on the week. So the options market priced in a move, whether it was to the upside of 61 or to the downside. Now we're reaching the upper end of that range into an area of resistance. Typically, you might see it just the price doodle around within this area. However, it's an important level to watch, because if we start getting above that level and pressing higher, it could create what's known as a gamma squeeze, pressing prices and price action even further to the upside. And what I find very interesting here during this time is what we looked at the previous video, and that was the asset managers, the NIM. What are they doing? And typically when they're bullish, they're up here in the 90s and 100, and if they're super bullish, they're even above 100. But we saw this actually peter out here, which tells me, hey, if the market does want to press higher, this should be updated on Thursday with the new data, but this means that asset managers get ready to pile in and chase this move higher potentially, which could create just a potential very forceful melt up to the upside. Now, that's not what I'm predicting per se, but it is a possibility, and it's something that is still on the table. What is the S&P 500 doing? Well, we broke down through this rising wedge, and we're ripping up higher to the upside. The upper edge of this range is probably right around 45, just above, I'd say 4,600 maybe, potentially right there in that range. It gets off this chart, but that could be a potential back test area to watch. And that, what is that, maybe about a couple percent higher there. Now, what has been helping this move significantly has been the US dollar, right? So right here, when we got into this upper end of this resistance range right here at 94.50, the dollar has been falling back down to around 93.50. As you can see, the S&P 500, when it was at around 4,300, it is now ripping right back above that 4,500. So it's an important one to watch, because we're at a very key level right here at 93.50. What once was resistance can become support potentially. So if the dollar continues to go higher, you can see that the S&P 500 might all of a sudden be a little lackluster or start to just ease off a little bit. And there's a couple other things at play here that we'll get into. Meanwhile, if you just look at the fear and greed index, everyone's bulled up again, right? People are saying it nonstop. Everyone's extremely bullish. Everyone this, everyone that. Well, yeah, the market keeps ripping up higher, but I think that people are saying that to an extent. I think the people that are only bullish are the people that got in before this move, because the price action in the market, it's been horrible, and we'll talk about that in the conclusion, right? If you miss the move, you kind of miss the move, because a lot of these stocks that are in the S&P 500 and looking at the S&P 500 by itself, well, it's just been gapping and camping basically every day. Question now is whether or not seasonality is going to play out, right? Is everyone prepping for that end-of-year Santa rally, the seasonal holiday rally where we just kind of go vertical for a couple of months? Well, October's not done yet. It's the 20th, all right? And we still typically on an average year get a sell-off reversal in October. Now, this is the average year. Post-election, you also get that. And then more in the middle of the month, which we're at right now, you actually do see a spike to the upside. So, it's anybody's game right now at this particular point in time. And now there are some red flags. Warning, red flags that are taking place in the market that I want to discuss in this episode. Two of which, actually, I should say, is So taking some of the research from Michael Gayad, it's an award-winning white paper. I would suggest you go read it, but it's looking at the relative strength line between utilities and the S&P 500, and you apply a 4-week rate of change. When it crosses from the bottom here up through 0, it goes into risk off. Now that doesn't mean, and you got to read his papers or watch our interview, his narrative, his way he explains this. It doesn't mean that a crash is going to happen, but think that you're driving in a vehicle, right? If the sun is shining, there's no cars on the road, it's fine to go a little bit faster, right? The chances of an accident are less. However, when this line crosses up through 0, it's basically saying, okay, you're in that same car. However, there's a very, very big storm brewing, right? It's raining. So you have to slow the car down to make sure you don't get into an accident. So that is what that means. It doesn't mean a crash. It means that the possibility for something to happen could happen given these circumstances, and you can read about that white paper and his research. Another one is the lumber to gold ratio. The lumber to gold ratio actually went risk on, which we discussed right before it was actually happening. And well, we got that big move to the upside in the markets, and we paired that with other various indicators that helped us really come to the conclusion that it looked like the market was heading higher here soon. But this is starting to fall to the south section, the southern direction, I should say, or I shouldn't say either. It looks like it's about to cross down through 0 here soon. And if that's the case, now this is on a weekly time frame. It might not finish there, but it's something that we want to watch, right? This is preparing ahead of time for seeing something that may happen, like in the last video where we talked about the 5 and the 35 spread. It's not a prediction, people. It's just looking at it and then thinking of a scenario that could potentially happen, so we're not sidetracked, and we have a prepared way about handling it if it were to occur. Now, what is happening? Well, lumber was down almost 5% on the day today. This is the continuous contract, but even the day prior to that, it was a pretty big hit to the downside, right? We're falling right around 800 back down to just below 700. So big move down in lumber. And gold, well, it's been finding a little bit of strength here, but this could still very well be in a bear flag. So this is something that we want to continue to track. What's another red flag? This looks like it's playing out exactly how it did last year, and we've been talking about this for quite some time. We talked about these symmetrical triangles on the BP NDX chart. And when it broke down here in September and it reached down to around this 35 and then it ripped up higher, well, we broke down here in September to October into this 30 to 35 range, and now we're ripping up higher where the RSI, it's not too far away from getting into that overbought territory. And when it gets overbought, it's not the place where you want to go long, right? This is where you want to either find short positions or take profits and then wait for, some moving average reconnects or maybe a pullback or something like that. But you don't want to press, gas all the way down to the floor, when our RSI is getting burnt up right there. And then you took a look at the BP SPX chart, another big rip to the upside. We actually talked also about this positive divergence forming, and that was right around here. So we had all these different ideals in our favor to prepare us for the move up. Now we're starting to see a couple of things that could prepare us for either a period of consolidation or potentially a minor pullback, and that's why we got to talk about these various things. Another thing is just look at the VIX. The VIX has been absolutely crushed down into this last gap down here. Now on the weekly time frame, there's a couple more gaps even farther beneath us, but here's this gap got filled, and we're still in a very, very tight wedge pattern that could very well burst us up. Now, I say this often, contraction leads to expansion. And if you take a look here at the Bollinger Bands, they're getting very tightly contracted, which typically means an expansion is not too far around the corner. You can see, for example, right here, we had this contraction. It headed a little bit lower, but pow, it moved up to the upside. And we still have these two gaps above us and one even higher above us that's even around 40, but it just doesn't show on this chart. Meanwhile, we also have a positive divergence showing on the RSI right here too. So, as the price is moving into this territory, these all-time highs, but it got there. The way that it got there was very forceful. It's not something that you necessarily want to chase, but I can understand why people might feel the need to chase it, right? Because it's just ripping. It's just going higher and higher and higher and higher. It's not going to stop and take a breath here anytime soon. And you never know. If it is a melt up, there's not that many breaths. And I'll tell you what, it's been very weird. Typically you get stairs up, elevator down, but lately it's been stairs down, elevator, rocket ship up, I should say. Let's take a look at the yields, because this is also going to factor into a lot of things here as well in the S&P 500. The 30-year started moving higher, the 10 years moving higher, the 5-year, right, the 3-year, they're all moving higher as of right now. We talked about the 30 and 5 spread. We prepared to say, okay, if the 5 keeps this big run up and the 30 remains flat or starts heading lower, start looking ahead of time for a possibility for an inversion. Well, it upticks slightly there, but it's something that we still want to pay attention to. But this puts pressure, it gets the Fed to act, to respond, and it's getting a lot of people to really, okay, this inflation is transitory narrative, it's just not, no one's having it anymore. You take a look at the CRB index and it continues to rip higher and higher. This is the basket of commodities, and it's definitely tracked by the Federal Reserve. And then you take a look at the PPO, it is looking like it's about to have a bearish crossover, but this thing hasn't even taken a breath yet, like me during this episode that I'm talking so much. Copper continues to just track higher here too. Oil is now above 83 on the close. Very, very strong move for oil. It looks like it might want to take a breath here, but every time I say that, we just start tracking a little bit higher. What's very interesting about oil going up like this is you would think that would put pressure on transports and airplanes, for example, airlines, because airlines, I mean, their biggest expense is oil. But you take a look at the transportation index, and this thing has gone completely vertical as well. Why did I bring up yields? Why am I showing you all this stuff? Well, yields are an important aspect to all of this, because when yields rise, the 30, the 10, it's potentially good for some financial stocks to an extent, right? But at the rate at which these things move to the upside, it puts pressure on tech. And as you can see here, tech didn't have that great of a day today, but everything else across the board was green, right? So let me just show you how powerful tech stocks actually are. This looks like, oh wow, I could be blindfolded, throw a dart, and I'll hit any stock that went up. You're pretty much right for the most part. A lot of stocks were up on the day. Very few here in the red. But what did that look like in the S&P 500? It was up 16 points, 0.37%. You can't tell me that these don't matter greatly. It is not the S&P 500. It is the S&P 10, 7. Yeah, it's crazy to me. So that is very important, because if yields continue this rate at which they're moving and we don't get all these stocks to play to just hold the market up, well, guess what? It's going to put pressure on the market to head down. And if you pair that with the dollar potentially moving up, right? It looks like it's falling down right now, but if it does move up and yield move up, holy moly, like this market can start unraveling fairly quickly. All right. Now I know that a lot of this sounds bearish, but we're in the conclusion section. I'm going to show you how I'm preparing for all of it, because the only stocks that I've been taking, I've only been doing long setups this entire time. I have yet to take really any short positions as of right now. I've maybe taken a handful this entire year so far. Now let's look at the SPY here on the 15-minute time frame. Let's hone in. 15-minute time frame. This purple line is the 5-day moving average. It was sloping down. It looked like a noodle. Now we're starting to get above, and it's starting to trend up. That's a positive sign. So now we need to start looking for reconnects, right? It's been getting a little aggressive to the upside. Might be wedging here on a negative divergence. We have 4 gaps beneath us. Sometimes those can act as a level of support. So what can we potentially do if the market wants to continue to ramp up higher? Look for areas to potentially buy the dip. That could be the 5-day moving average. The 5-day moving average comes down. It can act as a level of support, and that's something that we need to track. Further down the line, if we get an aggressive move to the downside, start looking down here at this volume shelf profile right at around 436 to around 438. Now it's time to be, like I said, be very careful in this environment. But if you're a shorter term trader, this is the 15-minute chart, so you can trade it in and out rather tactfully. I don't know. DIA, this is the Dow Jones Industrial, another rising wedge on a negative divergence. Momentum has been slowing, couple gaps there. The RSI is, not the RSI, the moving average. The 5-day moving average is sloping up here, and that's a positive sign that we're starting to move higher here. So that is a good sign for the bulls. But if we start breaking down, potentially come down to the volume shelf profile right around 349 to 350, or even the 5-day moving average to watch out for, okay? The Qs also just this relentless just drift higher on a dying off RSI, as well as the PMO is just momentum is just dying off. So it's just a very interesting area. Now we came up all this way into this volume shelf profile with previous resistance. So if we start getting back above 376, and maybe we see the yields take off, just die off a little bit, stop rallying so hard to the upside, that can really propel the monsters of the market, which is, you know, the FANG stocks. Now, if we keep moving down this list, IWM on a 15-minute time frame, there's a couple ways to look at this. We have the 5-day moving average sloping up nicely. Notice how it tagged it as support, jumped, tagged it as support, jumped, tagged it as support, jumped. So that's why I'm saying the 5-day moving average could act as one of those pivot levels to watch out for. Now, a couple ways to look at this technically. This is a potential ascending broadening wedge, which means you would take the length of which it started, right here, the pole, to down here. And then you would take that distance and measure it from the breakdown area. And that would be kind of like the full measured move potentially. So it's like 228 to around 223, 50. So it's a $5 move. Okay, so once we break, if we were to break down this blue trend line or get below the 5-day moving average, it could be potentially for a $5 move to the downside. And, you know, maybe that might happen up here, which would just come down to fill this gap possibly. Another way to look at this, though, is we see a little bull flag on the 15-minute time frame. And, you know, to be quite honest, I'm looking at the IWM to start positioning long in because I like it on the longer term chart, and I'll get into that here in the conclusion section. So first off, we went over the possibility for a lot of bearish things, but we also discussed the possibility for bullish things, including the squeeze higher, especially if asset managers are forced to just start getting in and buying more because we've already seen where they came in as far as the NIM goes. Now, it's been a very difficult market to navigate these last 4 or 5 trading days because of this. The market would just camp out in a single area. It would gap in the overnight session, potentially ramp up a little bit higher, and then just not do anything during the entire day. It'd end up being just kind of a range trading day, right? So you get this early morning burst, right? It trends up, cool, and then when lunchtime comes around, we just trend sideways. We do the same thing here, boom, it just went sideways. We gapped down, but we immediately got bid right back up, and then we went sideways during lunch hours, right? To the end of the day, basically, same thing. Gap, we ramped up in the early hours, and then we just ranged. Gap, ramp, range. So it's been a relentless tear to the upside, but the price action, there's no really discovery for price here. So it's been, like I said, very complicated. So if you're being impatient right now during this, I implore you just to let your foot off the gas a little bit, breathe, because the market will set up again. There'll be a lot of different setups. One including that I really like is this one, the IWM on the weekly chart. It looks like the MACD is about to have a bullish crossover. This could be potential for a big flag. A lot of small caps do very well with interest rates that go higher, as I've shown in previous videos, where during this run up, actually the yields were rising, not at a pretty rapid rate, the 10-year yield. And what that did was it put pressure on tech stocks. But meanwhile, and I think during that period of time that I'm discussing, it went up 23% in the IWM, but during that same period of time, technology stocks, the XLK, only went up around 3%. So it was a very big, strong performer. So small caps, I'm looking to see potentially break out here, but I need to get confirmation. I need to see this thing. I need to see strength come in. Perhaps maybe that's going to wait until a bullish crossover, or, you know, what we've seen countless times is that when we can't get over it in the cash market session, it gaps over and through it and you miss it in the overnight. So I might start building somewhat of a position and just managing my risk as time goes. Hope today's video helped out everybody, and I will see you back here tomorrow.